then I'm going back to screen sharing. And if you don't want to be in the video, make sure you aren't, your camera's not on. So this one was exercise 1-2A. In what it asked here was about the Wildcat Corporation. It said, for each transaction, indicate whether this other company, Falcon, who is the company we're doing accounting for, indicate whether they'd report the related account in the balance sheet or the income statement. And for accounts in the balance sheet, indicate whether it would be an asset, a liability, or stockholders' equity. For accounts in the income statement, indicate whether it would be classified as revenue or expense, and then what type of activity it is. So y'all are at the very beginning of the class. You may not see this yet, but this stuff is loaded. There's some things behind what they're asking that that they're setting you up for. So let's kind of go back to a few things from last week, and we'll be touching on them again this week too. There are 4 basic statements in accounting. You have to do a balance sheet. You have to do an income statement. You have to do a statement of cash flows, and you have to do a statement, some kind of statement of equity. Now, they have hit you right over the head in this exercise, even though you might not know it, with the balance sheet, the income statement, and the statement of cash flows. So they're getting you thinking about all these things here. And as we get into it, I'll explain how. The other one that maybe isn't clear yet, but will be, is that the statement of equity is a subset, or let's say it's a more detailed statement that talks about the equity section of a balance sheet. So while it's true that they may not talk much about that statement in this question, it's because the statement of equity itself, it overlaps the balance sheet. So one thing they've done here is they've acted like every transaction was done for cash. And one thing that concerns me for you all is that what they're doing this time with a very simple exercise, you shouldn't assume in every case. So you shouldn't assume that just because this time cash was part of the journal entry, you shouldn't assume that it's always that way. And I personally find students have trouble with that. I find that it's kind of a natural thing that a person starts an accounting class and thinks, oh, accounting is all about recording cash, recording when we spend cash, recording when we get it, but it's not. And once you understand it, which you all are going to do this semester, once you understand it, you understand why we don't do it that way. But still, a lot of times the predisposition is that we are going to do cash. So let me just give you one example and then we'll dive in. When it comes to a business, if we accept an account from somebody, if we let somebody take merchandise from us or take our work from us and not pay us at the same time, we are very likely to be paid. It's not like if you loan money to a relative and then you don't know if you're going to get it back or not. So anybody who's done that in their lives, like loan money to friends and relatives and didn't always get that back. And so they're thinking, well, this is why I like to make sure I have cash before I record something. It's not what we do in accounting. And it's not because we're going to collect most of this. It starts with, we do have a lot of good consumer protection laws now, and that's mostly a good thing. None of those consumer protection laws say you have to give somebody merchandise to take home that has a proven record of not paying people, or that you're required to let somebody take something home and you don't know if they're going to pay or not. What you're not allowed to do is treat different people differently. You can't look at some people and say, oh, I can tell just by the way you look that I'm going to let you take this home and pay later. And then another person, for some reason, you don't like the way they look, so you say, you got to pay in advance. You can't do that kind of stuff. But businesses can and do make everybody pay up front that they don't know, or run credit reports on people. There's nothing wrong with that. Also, when a business provides you something, in this case, we're doing accounting for the business. That in this example is the Falcon Company. When we're in business, if somebody doesn't pay us, we go to court. We go get a judgment against them, and we insist that they pay us. And so the collection rates are usually very high. So when you're safe like that, like a business, it's not like us as individuals worried about whether friends and family are going to pay us. These businesses are likely to get paid. They're not going to get paid 100% of the time, but when they get paid is not the biggest part of the deal. That said, let's go ahead in. The first transaction here is Falcon purchases common stock of Wildcat. So this one, and dealing with investments is a little tough at first. It's sometimes a little hard to distinguish financing and investments, because sometimes you'll do each type of transaction with the same company. So notice what Falcon did. It bought common stock of Wildcat. Later, we're going to talk about common stock of Falcon. That's something totally different than common stock of Wildcat. If we're doing accounting for the Falcon Company and we buy common stock of Wildcat, that's an investment to us. We're actually buying an ownership interest in them. When we're talking about our own common stock, we're thinking about who invested in us, and that's different. But now we invested in another company. So that's what they mean the related account is. It's an investment. On our financial statement, the one that that Falcon does, it goes on the balance sheet. Assets, which is all the stuff a business has, goes on the balance sheet. Then the last column is getting at the cash flow statement. I told you last time the cash flow statement, the three basic sections are operating, investing, and financing. And so number one is telling us that the activity here is on the investing section because we're investing in another company. Now let's compare that to the second one and what's happening there. So Falcon borrows from Wildcat by signing a note. So here, Falcon is going to call this a liability. That's the account type that a note payable is. We're going to call it a note payable, as we'll see later, because it's formal. It'll normally have an interest rate, and they'll have signed something for it. It also goes on the balance sheet. So I told you last time that the basic accounting equation is assets equals liabilities plus equity. And so liabilities also go on the balance sheet. But this time it's a financing activity. See, last time we bought stock in Wildcat, that was an investment. If we either loaned money to Wildcat, which is what we did, or if we loaned money or Falcon borrows. I'm sorry, I have that backward. Falcon borrows from Wildcat. So in this case, they're borrowing money from Wildcat. So that's why they're showing it as a note payable. But whether they borrow from Wildcat or whether they invest in it, I'm sorry, whether they borrow from Wildcat or whether somebody from Wildcat buys stock in Falcon, it's a financing activity, because financing activities are transactions with banks or owners. Number 3 and number 4 are standard operating activities on the cash flow statement. This is the primary stuff our business does. Number 3, Falcon provides services to Wildcat. We don't know what those are. It's very generic here, but when you hear the term provide service, what you know is Falcon has done something it should be paid for. So they're recording this as revenue. Cash is one side, revenue's the other when we get to that. Revenue shows up in an income statement for us. You see the account listed. It's a revenue account. And this is an operating activity to us. Falcon pays interest to Wildcat on borrowing. Now, this one's a little bit tougher. We went through the statements last time. The accounting standard setters basically said, look, operating, every company that is not a hobby should sell something. And whatever the primary thing it sells is, that's an operating activity. It has to be. It's what that company does to operate. But then they classified some other things like interest. And they said, interest is a thing that most companies have to pay. They borrow from other companies or banks or something. So we're going to go ahead and treat that as an operating activity. You can see it in your text. You can see it in materials. But it is not as intuitive that the accounting standard setters just said this belongs as an operating activity, whereas it's kind of obvious that the primary revenue from the business is an operating activity. So I'm just going to take a minute. You now see the answer before you, and I've talked about it a little bit. I'm going to take a minute, see if any of you have any questions. You don't have to talk if you don't. Just in 30 seconds or something, I'll move on to question 2. But if somebody has a question here, I'll stop and answer it. On the podcast that I'm going to make available later tonight, and I'm also going to make the PDFs available. Like whatever questions I put on a podcast, the only way I could have the image show up is a PDF. So I have those. So I'm just going to put that stuff out there for you. The first question is on the podcast, and there's going to be a PDF. This one's not, but it's the same general type of question. Again, Wildcat's doing transactions with Falcon, and we're asking some questions. What I'm going to do now is just point out differences between question 2 and question 3. Notice in question 1 and question 2. This is important, and it's easy for students to mess up at the beginning. Notice in the last question that now let me make sure I have this listed right. Okay, in the first question, we were looking at Falcon. These transactions were between Falcon and Wildcat, but this time we're looking at it from Wildcat's standpoint. And that's pretty important. It's a pretty important thing until you're comfortable doing it, that when you look at transactions between companies, you take a minute and think about which company you're doing the accounting for. Because if you do it for the other company, you're going to make mistakes. So this time we're looking at Wildcat and how it's recording things. Well, last time Falcon bought common stock in Wildcat, so it was an investment to them. But this time, Wildcat has an investor. Falcon's an investor. So Wildcat has to show this in common stock. This does belong on the balance sheet, just like it belonged on the balance sheet in question 1. But what's different is last time it was an asset for Falcon because they bought, an investment. But for Wildcat, it's equity. We have an owner. And we said the financing section is a section that shows transactions between owners and the company. But investments are when you invest in something, when you have something that you own. So last time, this might have been a financing activity. Sorry, the first one might have been a investing activity, but this time it's a financing activity. And then it brings me to the second one where if Falcon saw this as a note payable, Wildcat sees it as a note receivable. And I've got to tell you, spend some time at the beginning of class, the first few weeks, making sure you understand the difference between the terms receivable and payable. Because you see how in the first problem, we had something called notes payable. Here we have something called notes receivable. They both have notes in them at the beginning. And a lot of people think, oh, that means they're close. But really, receivable and payable kind of flags to us that the difference between these are night and day. Last time, the company borrowed money. This time, the company's lending it. So they have a note receivable. They have the right to collect money later on. Goes on the balance sheet. It's an asset. And because they have the right to collect money later on, it's not their primary activity, but they've got a right to collect money later on. This shows up in their investing section. It's an investing activity. Notice in the third one, Wildcat received something from Falcon. Falcon did some work for them. So notice they call it an expense. So I've come and gone at what I've called expenses. I'm not going to immediately disagree with whatever your book says about them, but sometimes I've called expenses money or something else a company pays to do work. And when I've said it that way, what I'm really getting at is almost every expense I can think of. And we'll look at a lot of them tonight, almost any expense a company has. The reason the company has the expense is they're trying to make money. So Wildcat's related account is service fee expense. This goes on the income statement in the expense section. It's an expense account and it goes in the operating section. Now, the last one, Wildcat gets interest from Falcon because they lent money to Falcon. The accounting profession says this is an operating activity. So Wildcat considers this revenue. I'm going to take about 30 seconds again. That's all I really have to say on it. And then I'll move to the third one. So this one's pretty easy, and it's also in the podcast. Here we're trying to get you thinking about the accounting equation. So we have Eagle operating the magnetic resource imaging clinics throughout the Northeast. At the end of the period, they have all these things. Calculate net income. Now, if you looked at the materials, thought about what we said last time, net income is revenue minus expense. So it's real easy. All you do here is take the 14,000 revenue, subtract the 9,000 expense, and we have net income 5,000. And hopefully that explanation did something for you, but if it didn't, look at number 1 at the bottom. I know you can't see down to number 2 yet. I'm going to bring that up in a minute, but at number 1, you can see the calculation right there. 14,000 minus 9,000 equals 5,000. Number 2, calculate stockholders' equity. So this one's just a little bit more involved. In the accounting equation, we say that assets equals liabilities plus equity. So if you go back like the math professor would tell you, and you rewrite the equation, you could write equity equals assets minus liabilities. So that's what you see in the second question. This is what you see at number 2 in the explanation. The assets were 50,000. The liabilities are 27,000. So we subtract them. And it makes the stockholders' equity 23,000. Simple enough. I'll say on test 1, you might have a little bit of accounting equation stuff like this. We get past it pretty quickly, but as I warned you about last week, we usually only get past things by getting to the next step. Accounting's a series of easy things, but as soon as you miss one easy thing, then it becomes hard because you got something else you're building on with it. So we're not going to forget these because they're not important. We're just going to use them other places. So doing a simple math calculation won't be as useful to us as other ways we can make sure you know that, equity is assets minus liabilities. But here again, I'm going to give you about a few seconds to ask me a question if you have it, or we're going to move into number 4. Okay, these to me are like very useful and will remain useful all semester. So a big thing to me, if somebody asked me coming into accounting, basic accounting class, if you could tell me what the most important thing I have to do in here is, what would you say? And my answer to that would be, well, there's not just one important thing, there's 3 or 4. But here's what they are. You got to do journal entries. You've got to be able to do those. We're coming to them. You've got to be able to do the basic financial statements. And with something like this, I tell you, when it comes to test 1, if I ask you a question about the income statement like this, imagine that instead of being your accounting professor, I'm your cake baking professor. So if I'm the cake baking professor, I might put some things on the table to see if you know what belongs in a cake and what doesn't. But just because I put everything on the table doesn't mean I want you to use it all. So you can see here, there are things we don't need, and we're going to talk about that. But following up on the cake analogy, if I put things up on the table like eggs and milk and sugar and rat poison, I don't want you to use the rat poison in the cake just because I put it up there. I would make it dangerous. So if I did that, what you should do is not use the rat poison. So here, the things like rat poison are anything that doesn't belong on the income statement. So cash doesn't belong there, and you don't see it any place in there. And it's like I told you a few minutes earlier, knowing when to deal with cash and when not to deal with cash, and that cash isn't always in every situation, is a very primal and basic thing for new students to get into their heads, is that doing accounting is not figuring out where cash comes from and goes. It's more than that. That's how last week when I told you WT Grant was profitable every year, but then they went out of business. It was because we, as a profession, got so far past just counting cash that somehow we let them never collect it and go out of business from never collecting it. And we couldn't say that. And we've learned from that how to do it a bit better. But just reinforcing the thing here that this stuff is not all about cash. In fact, cash doesn't have any place on an income statement. Salaries expense belongs there, but look where it belongs. You see service revenue at the top. You see salaries expense in the third column. I'm sorry, the third row. I mean, really, I guess it's the fourth row. Although, let me not bother with that. I would rationalize that answer, but the point is expenses themselves as a whole show up on the third row, and salary expense is the fourth row. It's not the top. Accounts payable has no place on an income statement. It belongs on the balance sheet. So that's another toxic thing, that just because I list it there, you don't need it. Supplies is another thing that belongs on the balance sheet, not the income statement. So you don't need it. Service revenue belongs, and it belongs right at the top. So that's where you see it is. And common stock has no place on the income statement. So now let's talk for a few minutes about Connect. I blew past it on the earlier questions, but let's address it here. Connect has a very tough job, and I've been watching it and using it for years, and it's getting better and better. Connect has to have something out there so that you can put all the things that belong in the right places there and prove you know something and get a good grade. But at the same time, it has to have a way of allowing you to put things that aren't necessary. If it only had enough space for you to put the right answer, and if you keep getting things wrong until you put the right answer in and you couldn't even move forward, it would kind of steer you too far to the right answer, we think. So what they do instead is they create a statement like this with a little bit too much stuff. And if you, I know you probably did it when you were working, but if you hit these drop down bars, let's just see what shows up here. So you had all these choices you could have put in instead of service revenue. But if you'd have put any of those in and then checked your work, it would have been wrong. Notice that they wanted to allow you to put in a second account as revenue if you wanted to. It wasn't going to be right. They were going to mark it wrong, but they wanted to let you put something in there. So again, there was a drop down. You could have put any of that stuff in. Notice they did the same thing down with the expenses. Now I can tell they did give you expense as a caption. They gave you 4 spaces to put expense accounts in, and then they gave you a total figure. They said, go ahead and throw the expenses in here, as many as you can find, and then we'll keep totaling it up and put the total in the total expenses line. But you can see here, you only should have taken salaries expense and utilities expense and put them in here. And I'll tell you what, real accountants and real like income statements, get tired of writing the word expense. So ordinarily, they would write expense at the top, and then they would just write things like salaries and utilities. And they would consider it was obvious that it's an expense. But for now, and as long as you see them this way, if the authors will tell you something's an expense by writing that, then it's a good bet not to show anything else except things that say expense. Finally, if you got the service revenue right and the expenses right, you see net income at the bottom. So you might have noticed in all that stuff I told you was in the Connect stuff, that we have these things, you see them on the syllabus too. I think they're called financial analysis projects or something, and there's about 3 of them during the semester. I'm going to use those to try to see that you could answer test questions without having Connect in front of you. So one problem I've noticed students have had, I love the Connect system. It's very helpful, but sometimes it can be a little bit too much of a crutch to a person. So you do need to know how to do this income statement. You need to know that revenue belongs on the top, expense belongs on the bottom. It totals out to net income. So on a test, you might not have much of that template at the bottom. You might get a list of all those accounts and have to create a statement. So do pay some attention to how this is looking in the book and how the statement needs to look at the end. This is question 4, important, first of the financial statements. And now I'm going to go on to question 5, unless I have a question. So the statement of stockholders' equity, as I told you before, is a little more detailed, but it's showing you stuff that's already on the balance sheet. Now, every Connect question is different from the last. And I will tell you, I don't know if all of you know each other. I know you sisters know each other, obviously, but sometimes I assign static homework, and static means it's the same for everybody. And sometimes I assign algorithmic homework. And what Connect works real hard on, to be fair, is if something's algorithmic, everybody gets the same question, but they get different numbers. So be careful. You don't know which ones are algorithmic or which ones are static. So as we go on, you might see me reviewing homework, and it might not be the same answers that exactly that you have. It should look very similar, but the numbers might be different. So here, this is also something I have in the podcast, and it says, at the beginning of the year, Buffalo Drilling has 11,000 of common stock outstanding and retained earnings of 8,200. During the year, Buffalo reports net income of 8,500 and pays dividends of 3,200. In addition, it issues additional common stock. Prepare the statement of stockholders' equity. All right, so the first thing you have is beginning balances. Now, I like this problem because too often in accounting classes, the authors like to start you out with a new company. And I understand why they do that. This way you can see how to do some of the very beginning and basic transactions. But the problem is, most people who get accounting jobs don't start at a new company. So their beginning balance is the beginning balance for a year, but it's not 0. So I like that this problem doesn't start at 0. So notice our first clue is that there's 11,000 of common stock outstanding. So that shows up in beginning balance. There's retained earnings of 8,200. So that shows up in beginning balance. And if you put those two in there correctly, it would just calculate to 19,200. Then they told you there's more common stock. Now watch out. Sometimes they don't have that, and this blank space is actually just necessary in there. See, here you could have picked the blank space, but it would have been wrong. So the next thing is to add net income. We're going to talk more about this tonight, and we talked about it last time too. Net income is income for the year. It does not go into common stock. Common stock is what people buy. You know, when the company sells investments, it sells common stock. Retained earnings really means cumulative earnings. So it really means, you know, in this case, there was a beginning balance. It might mean we had $8,200 last year of net income. We don't know. Might be for the last 50 years, they had some losses and some gains, and they netted to 8,200 in retained earnings. But here now we have 8,500 this year. And the way you read the stockholders' equity column to the right, the only retained earnings we have is in column 3 is the stuff that's coming over from net income. We already had the retained earnings back at the top and we dealt with it. So here we just bring over 8,500 and total stockholders' equity is 8,500. Dividends are not any normal activity of the business, any ongoing activity. This is when a company actually pays out its shareholders. So I could talk too much about this. Let me work hard not to. I think I'll be successful, but I could give you a lot of stuff you really don't need to know for the course you're taking and you might not care about. Normally, people do not take money out of a corporation. They will take money out of other types of businesses they own. They'll take money out of a sole proprietorship or a partnership. Sometimes small business owners don't even they really look at the business as an extension of themselves. Since they own the business, if they need some money, they just take it out of the business. But that's odd, and we're not looking at that now. In a corporation, normally the owners don't take money out of the business, but the company's actually required to pay them. See, this is one place I could get long-winded and won't. The IRS will punish companies for not paying out some dividends if the company has earned money. So that's probably all you need to know, is that the normal term we use when we're paying the owners of a company that's in a corporation some money back is we call that dividends. Excuse me. And so that's a subtraction. It reduces the stockholders' equity. And then we have this ending balance that you see, 32,500. Just give you a few minutes there. And hang on just a second. I'm going to stop the screen for just a second. I've got some water close by, but it's not right here. So I'm going to go over, get it, and then we'll continue. I'm not even going to stop the recording. Sorry about that. Now back to screen share two. Question 6 is another very important question. This one has us looking at a balance sheet. And just like the income statement, you need to know what this looks like. And you should be able to prepare one on a test where you don't have Connect right in front of you. I'm going to try to have you do that on the financial statement analysis stuff you're doing. But do give some thought to if you had to do this without Connect, if you could. And really all you would need to do is know the basic outline of the balance sheet and look at these accounts we gave you. So as we deal with these, equipment belongs on a balance sheet. It's part of the stuff a company owns. I'll tell you something here that we wouldn't dwell on, but you might find it useful sometimes. In accounting, the assets on the balance sheet, just the assets, are set up in the order of liquidity. And you might have heard the term liquidity in some other business class you had. In business, the term liquidity is kind of like a metaphor between water and cash. So if you think about water for a minute, liquid water drips out of your faucet when you turn it on. So there's nothing more liquid than water. Water is liquid. On the other hand, we're dealing with the ice now. If the water has frozen solid, whether it's ice that came down from a snowstorm, whether it's you put your water in the freezer and it froze, it's going to take some time for that to turn to liquid. So that's the same analogy we have with the order of liquidity. There's nothing more liquid than cash. Cash is cash. I've seen land and equipment grouped differently, so I'm not going to steer you too hard on these two. Individual accountants would come through and try to figure out which was more liquid. And if the people doing this statement say land is more liquid than equipment, that's fine. Ordinarily, I've seen things like accounts receivable and supplies between cash and land and equipment. So giving you that background here, when you see equipment, you know it belongs on the asset section. You know it belongs on a different line than the top. Accounts payable belongs on the balance sheet. It's a liability. Remember I told you earlier in the class that notes payable is a structured liability. We've signed, there's been a note signed, there's an interest rate, a list of when payments are due. This is not true in accounts payable. The most common account payable, there's a lot of them, but the most common one is if a company, let's say, has inventory. We'll pick on Walmart for a minute because everybody has been in those and knows how they're laid out. So Walmart does not pay for inventory when they get it in the store. They order it and they pay 30 to 90 days after they get it. But as long as they pay short term like that, 30 to 90 days, their agreement with their vendor is maybe something they signed at the very beginning or something, but it certainly doesn't cover. I mean, what I guess what I'm trying to get at is they might have an agreement at the very beginning that covers every other thing they do. But when Walmart goes and orders 50 snowblowers, then there's no rewrite of the agreement for that. And Walmart's not charged interest by the company that sells them the snow blowers unless it takes them a long time to pay. So that's the difference between these two. Accounts payable. There's no interest rate usually. There's some kind of common agreement that whenever the one company wants to order something from the other one, they can, but a note's more structured. So accountants then usually say that accounts payable are more liquid than notes payable, which is why they wind up at the top. Salary expense doesn't belong here. Let me give you a little clue. The last question, question 5, and this one, question 6, there's no overlap on the income statement and the balance sheet. Something belongs one place or the other, but not both. So if you had to use, the numbers might have been different, but if you had to use salary expense on the last one, it doesn't go on this one. And it doesn't. Common stock goes on this one. And the order of liquidity might be kind of irrelevant here, but we do always put common stock before retained earnings. Instead of worrying about that as liquidity, you might just accept the idea that common stock always goes before retained earnings. So then we have land listed, and land goes back to being an asset. Notes payable, also a liability, and you see it over there. Service revenue doesn't belong. It was on the income statement. Cash belongs, and it's at the very top. I would say a safe thing for you to do when you're doing a balance sheet is look down the list of accounts, and if cash is one of them, it's the top one. It's the most liquid. And retained earnings belongs there. Now, don't forget what I said to you last time. It might be hard to balance a balance sheet sometime. I'm not saying that it wouldn't be. Some balance sheets are a little tougher than others. We'll throw curveballs at you to make sure you can do a balance sheet. But at the end of the day, a balance sheet has to balance. For the reason I gave you last time, these things are not equal. They're the exact same thing, just shown different ways. So you can't have cash, land, and equipment and not have the claims on that equipment or the liabilities plus the owner's interest not equal the equipment. So no matter what reason you would have, if you had 50,000 on one side and 51,000 on the other side, you're just wrong. There's no possible way you wouldn't be wrong there. I'm going to give you just a few seconds to see if you have questions on that, and then we're going to move forward. Okay. This is the first statement, and I think it goes this way for the whole rest of the exercises. I don't have this one in the podcast, and I think I only had like the first half. I'll tell you all, it's not going to be as simple as I only put the first half of them in. The biggest reason is I was thinking about the podcast is I wanted to have all the 4 basic financial statements, or at least the 3 of them. I've said to you before, people in a basic accounting class need to know a cash flow statement exists. They need to know what it shows, but preparing them can be kind of tough. And so I'm not sure how much preparation we'll do of them in this class. And we didn't have to prepare one in this first group of exercises, so I didn't show one here. But basically, I think we're going to work at this for about another 5 minutes. Then we're going to take our little break, and then we're going to come back to chapter 2. And most likely we won't get through all 10. This might be a reasonable time for me to offer that if there's anything in the last question, 7, 8, 9, or 10, that you were wondering about, because maybe you had a hard time with that question, it might be something you want to ask me about, because I won't necessarily get to all those. So if somebody said, well, I was really hoping you would show us number 9, maybe I would just go to that one.
I actually had a question on probably number 8. Yeah.
All right. Well, I'm going to turn to 8. Tell me if that's the one you're looking at.
Okay.
Is it that one?
Yes.
Okay. What's the question?
So I was just like going at like it might just be like a me just being dumb, but
Did you say dumb? No. Accounting's easy, but it's not intuitive to everybody. So no, I'm the only one that could say anything dumb in here.
Okay. Well, I was just setting up the equations to try and find out, like, I guess in this instance, it was for PepsiCo. So the second one, I just couldn't figure out how to set up the equation to find out what the missing net income was. Like, I just tried doing it, and for some reason, whenever I put like X in for like, I guess, net income, I couldn't figure it out, and I just wanted to see you do it. Just so like put my mind at ease, I guess.
Okay. So this is one of those things I'm going to do by pulling the whiteboard up so you can see it. Cause this is so easy. I could say it to you. Yeah. I really think you wanted to overthink this. I think you don't believe this could be as easy as what they wanted you to see, but I'm going to pull the whiteboard up. I know I'm showing up in a little corner of your screen. I'm going to bring the whiteboard right there. Like, it's not even very important whether you see me or not. It's important you see the whiteboard. Anybody let me know if you think this needs to really get more prominent in the video, but otherwise, I'm going to give you the simple answer for this now, and it's going to surprise you. Do you see how, first of all, that for number 2, the net income they gave you was $6 billion?
For number 2. Yes.
Okay, so now I'm going to show you how they get the $6 billion.
Okay.
This is a big whiteboard, but the good news is you can't see it all, but the good news is I can see what you can see. And so I think this is easy enough. I can just fit it right there. Yeah. I'll bet you didn't think it was that easy.
Is that plus? Yeah, it's obviously.
Yeah. So what they did is, let's start here. If net income is $6,000 and the company paid out 2.6 billion in dividends to owners, that may or may not relate to the 3.4. Okay. What would happen to retained earnings is it would go up a full 6 billion for the income, and then it would go back down by the amount of the dividends. So what they did, I'm going to show this a slightly different way so you can kind of see how the math actually would have worked. This is the answer. We don't know that number. We don't know that number. They didn't tell us what that number was. Okay. I abbreviated some of that. So the way you would get retained earnings is you'd have an old retained earnings number. You would add net income to that. You'd subtract dividends from that, and you'd get to new retained earnings. There's actually something I'm not telling you here because it's way out there. But if you go back and you look at that statement of retained earnings you had, I forget if it was question number 4 or 5. If you had new investments by owners, you'd have to put them in here too.
Okay. The only other question I have against what you have on the board, I guess, is that we weren't given net income, so I didn't know that it was 6 billion. Like that's the one we're solving for.
No, right. I mean, I'm not sure I'd ask you a question like this. So this is Connect. I'm not sure I'd ask you a question like this, but they expected you to know, which is why they gave it to you, that if you have retained earnings 3.4, you have dividends of 6.0 and nothing else, then the dividends were subtracted to get to the 3.4.
Okay.
So basically they thought they gave you enough information.
Okay.
To get there. They thought when they told you the 3.4 and the 2.6 that they gave you enough information to get there.
Okay. I see that now. Okay. Thank you.
Sure. Again, I don't know if I'd give you one like that. I'm not sad that they did. I mean, I think it gets you thinking, but I'm not sure, when you're doing things with Connect, you're learning. When you take a test, or in this case, the other thing you have coming up is a quiz. You've got a quiz. That's something that's due next class for chapter 1. I don't even assign those until we've been through the homework, which we did now. But those are kind of testing what you know. But these, even dealing with exercises tonight are kind of getting you to think. And so I'm not sad that they got you thinking here, but I'm not sure that's a question I would ask.
Okay, thank you.
Is there anything else with this? Because I think I'm going to leave this at those several questions, and you'll find that the podcast and the PDFs I put out to you have all of those except for question 2 and question 8. But question 7, 9, and 10, you can see the answers on something called study attempts. You can go back and do study attempts even after the due date passes. Also, Connect gives you some feedback different ways, but you just won't be seeing it from me. But you can certainly ask anything. So if ever, one way to do it's just like you're doing now of, hey, why don't you ask that? Why don't you make sure you show us that one? But another way would be, okay, we get into chapter 2 and you're going back and thinking about it. And you're like, I never really understood how we got one of the answers for question 10. Well, you could ask me and I'd be happy to tell you anytime. But let's go ahead and take take a short break. I'm going to take about 5 minutes. I'll tell you one reason I think like this. Sometimes in long classes, I've seen pressure from one place or the other to meet the whole class period. And then at different times in the past, I've seen a good mix of students that wanted a cigarette break. And a cigarette break is roughly a 10-minute break. I could tell you about how when I worked my first job in Virginia, if you worked in the morning, Virginia used to be a tobacco state. And if you worked in the morning, you did not get a break, you got a smoke break. And it was set up at a length of time for smokers. It's not like they forced you to smoke, but it was like they gave you a break around the idea that you were going to have to smoke. And so at different times I felt a little bit more strongly about thinking about a smoke break, which should be about 10 minutes. But the downside is if we keep it to 5, then we just finish up a few minutes earlier. So, how do you all feel about that? It's a 5-minute break good, or do you want to break a little bit longer?
I don't mind a 5.
All right, looks like 5 is what we're saying. So I'm going to go ahead and turn off my sound and video, and I'm also going to stop recording. I'm going to pop back on in 5 minutes. And when I would encourage you not to leave and come back in, but you can do what you want. But in about 5 minutes, I'll pop back on and be like, oh, there he is again.